Hello, everyone. This is Doug Campbell-John, your host of Revenue Renegades. And this week, I'm excited to welcome to the show David Spitz, the founder and CEO of Bench Sites. I first heard David speak at a Winning by Design conference back in the spring and was kind of blown away by the stats that he was sharing with the audience at that show. So I'm very excited to have him on the show. David, welcome.
Yeah, thank you. I mean, it's a pleasure to be here. Sorry it's taken me so long, but I'm excited to have this conversation together.
Fantastic. Well, we love to talk about founding stories. So, you are the founder and CEO of Benchsight. So, tell us maybe a little bit about why you decided to start a company. What was
That
the
I am. I will try not to make this too long-winded because it's been a 4+ year journey so far. It's been really fun. I am not your typical founder of a software startup. I was an investment banker for 25 years, and the genes that make you good at investment banking probably do not make you good founders or even operators for that matter. So I'm still learning, but I was passionate about metrics. So and the company is Bench Sites. That's probably going to be listed here. I basically approached investment banking in kind of a metrics driven way. So I went into banking as kind of a nerdy kid who was good at spreadsheets, so a grunt, if you will. And I in investment banking, this is always true. The transition from being a grunt to a salesperson, because ultimately, if you're going to succeed at anything, but especially something like investment banking, you've got to be a good salesperson. And in that mid part of my career, I realized I probably wasn't a very good salesperson at that point. And it took me a few years to kind of get get kind of my own thing going. And the thing that I found, and it didn't work for everybody, but it worked for people who were kind of thinking about how they wanted to tell their story. And I covered software from the very get go, so I was always passionate about technology and software. I'd actually been a computer science person as an undergrad, and I just figured out that basically metrics was a great way to tell the story. And I was kind of coming of age when SaaS was coming of age. So I was lucky enough to be working on some pretty fun deals. Even your old firm, Salesforce, was one of
Mhm.
my clients. And in those days, there was a lot of questions about like what makes a company good or bad, and how do you think about the new metrics? Because the perpetual license model had very, kind of different traditional metrics, and we were all figuring out like, well, what is SaaS like? And I remember Steve Cakebread came to us as a banking group when we were kind of figuring out the prospectus. And he's like, well, how do we think about churn? And churn was really high for Salesforce, actually,
Uh-huh.
in those, this was 2003. And we were like, well, maybe the cable industry, things like that. So there was a whole
Huh.
kind of back and forth about how to think about it. And their churn, by the way, was like 2% a month or something. It was
Wow.
crazy high because it was, they were selling to small businesses at that
Yeah.
point. And so I'm not saying I invented all those terms, but it dawned on me like, hey, I think like this. I think about metrics a lot, and I don't know what good and great is. I don't think anybody does,
Huh.
because, well, in those days there were hardly any companies doing it.
Right.
Over time, more and more companies started doing it. Fast forward to about 2010. Now there were probably dozens of SaaS companies, maybe 100, maybe 200, and it dawned on me, I I don't think I still don't think anybody really understands what good and great is, and the only way you can do that is if you understand what's going on in the population. Obviously, if you're the best, you're great, and if you're right in the middle, you're the median, and that's kind of the benchmark. So, I started a survey back in 2010 that was sent out, and we could do it by email at that point. Just send it out to people. I had everybody's email address because they were all my prospects, and I would run this survey, and people would respond anonymously and give us their basic metrics. And the terms like NRR didn't even exist yet, but
Right.
we were over time each year getting better at it, thinking about it, and we got back great responses. And I partnered with some other firms, and it became a thing. It became really a big thing, and it getting back to the sales, I know this is a sales podcast. Like I got good at sales through like being the nerdy metrics guy that actually could help you tell your story. And each year we would run this. I was at a place called Pacific Crest Securities. We'd run this Pacific Crest survey, and it was the thing, man. And I would go into a meeting with people I'd never met before, CEOs of, the hottest software companies. And I'd have the banker book because you were supposed to. I had the slick back hair, but
Mhm.
basically they said, put that away. I just want to, go through your survey and
Nice.
talk about our metrics. So, fast forward now to 2021. All those years, it did work really well for me, but I also felt like there were all these things wrong with
Mhm.
how we were doing it. It just inherently wrong. I mean, first of all, who likes taking a survey? Nobody, right?
Right.
So that was an issue. And then when you compare year to year, there was just a lot of things wrong. And everybody would say, "Yeah, I love your benchmark, but I'm different. Like I'm a security
Right.
company,
Right.
and my average contract value is below 10K. So my benchmark's going to be different. Do you have that?" I'm like, "Well, yeah, I mean, I can." And if it was an important prospect, we go off and spend a day or two with our analyst, like putting together a special presentation for them, comparing their metrics and all that. But I'm like, you know what? This is classic. Like, you can automate this, and you could make this something that is built to do this in real time and is always up to date. So you don't run the survey once a year. You have it so everyone's putting metrics in and understanding what's, basically that initial question, like what's the population? And of course now the population's, thousands and thousands of SaaS companies.
Mhm.
And so we've been building a benchmarking platform, a product that lets you contribute anonymously. So the anonymity is built into it.
Mhm.
Everything is aggregated, so it's safe in numbers.
Mhm.
And so, if you're one of hundreds, one of thousands of companies contributing your data, even if you're saying some other things about yourself, like, "Hey, I'm a security company," you're still very safe, safe in the herd, if you will.
Got it.
Um, and what we've built now is something that really works well for that. And it's Benchside SaaS Metrics is the product. We actually use the platform for other things too, which we can talk about. But the main thing I've been working on, and we're really is timing of this is fantastic because we're really just pushing it out to the market now, mainly through investors at this point, but ultimately to individual companies. Is you contribute your metrics anonymously, and you get to participate. You can't just like click on a link. You have to prove that you're a real company,
Mhm.
and that you have the metrics. But ultimately, once you give to get, but it's totally safe, and the getting is just so much better. And
Mhm.
it's a PLG model, so
Yeah.
people will pay us over time, but we recognize that we need to build the data set first. So that's where we are right now. Long-winded answer.
No, no, and how are people contributing their data, right, instead of the survey approach? It sounds like they're connecting one or more of their systems to you.
So there again, this goes back to some of the learnings.
Mhm.
Um, you still have to provide your data in some fashion, but instead of taking a survey saying, "Give me your NRR, give me your growth rate," there's a lot of distrust in like someone just telling you their NRR. I mean, I'm kind of skeptical when someone tells me what their metric is. I want to see it derived. It's not a complicated calculation, but it's still a calculation. So if you're coming in direct, the first thing you do is you fill in the waterfall, and it's
Mhm.
graphical. It's very visual.
Okay.
So and it gives you the feedback. So you say, it's always a 1 year look back. You need to do it that way. What was your ARR a year ago?
Mhm.
What did you add from new logos in dollar or euros, or it's multi-currency? What did you add from your base? So customers that you had at the beginning of the year, what did you add dollar value? And then what did you lose, either completely lose or downsell? And you'll see that in a waterfall or snowball, as some people call it, and you'll get the feedback. So on the bottom, so this is all done. It's a very graphical, interactive format, and so you put those numbers in. You may look at that and say, "That's not my NRR. Like I have it differently." and it's okay to do it differently. I mean, if you look at public companies, everyone does it slightly differently, and of course, they all I was a banker, you do it in a way that looks the best, but what we're trying to do is do it in a way that it's apples to apples. And so you get that feedback, you see what your metrics are, and everyone's being done the same way. And then as soon as you submit, and if it's your first time, you get a code name. So at that point, you are that code name.
Okay.
As soon as you submit, you'll see the benchmarks.
Hmm.
So you've got them, and there's just headline benchmarks, but then you can drill in. You can say, well, my NRR is 105%, but again, I'm different. Like I've got a lower average sale price, so that's pretty good if you're selling a $200 product. So I wonder like how that compares, and you can drill in and then see and basically look at, instead of 500 companies that the overall benchmark is, you might only have 20, but that's still really good. And so that's kind of the process you go through. Now, right now, our focus is going through investors. So the companies that are in our platform right now, most of them don't even have to put their metrics in because it
Hmm.
turns out investors do a pretty good job of collecting this data every month, in some cases every
Right.
quarter. And so those investors use our API to put the
Hmm.
data in all anonymously. We have no idea who the companies are. Every company goes in as a code name. And then the investors in turn, and they then provide those links or basically, a mechanism for those companies to get in and see their metrics, but also see the benchmarks.
Right.
And it's interesting, some look at them and they say, "Hey, that number's not right. Like that's not my NRR." And so we go back and forth with them, but it's a really good process because guess what? The investors think that's the right number.
Right.
So,
Right.
it's interesting. So that's how that works, and over time, we're going to add more metrics, and we're going to open up the platform to companies. We're going to more aggressively go after companies individually. So that's been fun.
Very interesting. What are so I assume then obviously there's the individual value that a company or an investor is getting, but also there are these aggregate, things that you're seeing across these companies. You said it sounds like there's several hundred on the platform now. Is that correct?
There's several hundred where, most of those have come in through our private equity, and VC customers.
Uh-huh.
And and then we also have some public companies on the platform, and
Uh-huh.
a lot of, I know what I talked about, with Jocko, and I post about on LinkedIn is a lot of the public company data, which
Uh-huh.
is very good. You can't get every metric. So, again, not every company will disclose NRR. Almost none of them disclose GRR, the
Uh-huh.
gross churn, but you can get actually quite good metrics. And, arguably the metrics are even better than you're going to get from public companies. They're bigger companies and so on. So a lot of what I've been focusing on so far are the public company metrics because we're still getting kind of to critical mass with the privates, although we have some pretty good information with privates now. And it's, as I like to say, this is a chicken and egg business that I'm building.
Mhm. Right.
The good news is we have a really nice looking chick right now, and it's uh, it's growing, and it is high quality data because I know our partners, and the partners are extraordinarily high quality. uh, I have a lot of relationships from my banking days, so that
Right.
helps a lot. But getting back to your question, um, I'm going to focus mainly on the public companies and what we're seeing over time. I'll have a lot more to say about what we're seeing amongst the private companies, but in the public companies, what you're seeing, the metric that I hone in on a lot as the starting point is growth. I mean, because
Uh-huh.
I think we all, people tend to get confused, and I think at least, and this is kind of with my banking hat on. Um, there's this notion of, well, it's good now. Profitability is better, and those are kind of the two things. So you got growth. Growth is down extraordinarily from where it was in 2021.
Yeah.
So just to give you some of those numbers, the growth rates, the median growth rates across about 75 public companies that are, that people would consider SaaS companies was in the mid 30s, called 35, 36% back in
Mhm.
2021. And by the way, if you go back further, to because a lot of people say, well, that was kind of an aberration that year. That was when all that craziness was going on, and there was craziness in valuations. The growth was not off the charts from where it had been for
Huh.
most. I mean, yes, there were some companies that it was particularly off the charts, who were feeding on the all the venture backed companies, but that mid 30s, 40% growth as a median, as a midpoint across 80 companies now, and maybe it was 70 then or whatever. That was the case if you go back to 2019, if you go back to
Huh.
2015. So that wasn't an up aberration. That's where things kind of were. Um, and now that median growth number is sits at about 15%. So
Wow.
it's off by more than 50%. Um, and what's interesting about that is it's not like, all right, some are up, some are down. Virtually every company, in fact, every company, it's down. There are only a very small handful, like companies like Palantir, where it's bounced up,
Huh.
but basically it's down and it's stayed down.
Wow.
So that to me reflects what is going on broadly across, not just public SaaS, but almost everywhere. Now, there are exceptions, and the most startling exception that we're all focused on are all these AI native companies. And I don't mean to put them in a bucket like they don't count. They of course count a lot, but those are smaller companies. It's not like we all like to focus on the ones that are highly visible, the cursors of the world, and obviously OpenAI and Anthropic and folks like that, and Replit. But there there are more than a handful of companies that are growing very, very rapidly like that. And hopefully, that we'll see that. But I think that the vast, vast majority of companies, and I'm guessing the vast majority of people listening to this podcast are dealing with what we're seeing in the public SaaS space.
Right.
So that's kind of sets the table. The other side is the profitability.
Uh-huh.
That's gone up. So
Yeah.
that has gone up a lot. Like that was break even in 2021. And now it sits at like median sits at like 18% free cash flow margins. So that's good. And we shouldn't take that away from folks. That's a good thing. But that should not make us feel like, well, the valuation should be up now too, because we have rule of 40. And of course, we can trade off profitability for growth. And my answer to that, based on looking at valuations and data and thinking about these things for a while, is no. That is not a valid way to look at the world from a valuation standpoint. Valuation is much, 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 much more uh, oriented towards sensitive to growth. The
Right.
growth is much more important. Now, you can borrow money more easily. You can get private equity funding. So, if you have profitability as well, or instead, or whatever it is, but growth is really where things are at. So,
And
um,
what are you seeing in terms of those growth bands? So, like, if you think about, like, you're in a certain amount of growth, and what are the valuation multiples you're seeing for those these
yeah,
days?
I don't have those stats on the tip of my tongue, but
Okay.
Um, I mean, I can kinda well, the first thing I will tell you is that, um, the number of companies that are growing, let's I just did this about a week ago. I put something together where I looked at companies growing, over 35%, saying like
Mhm.
for a company of size, like a company in the 500 million ARR plus
Uh-huh.
range, and most of the publics are, of course, in that, some well above. Um the percentage that are growing north of 35% now is like 5%. I mean,
Wow.
that's it, of the public companies. Um, those companies today will trade at, I think I'm going to get this right. I think the median for the companies in that range are like, it's north of 15 times ARR.
Okay.
Um, so that's nice. Now, back in 2021, that was like, in the mid 20s
Mhm.
times ARR. So it was, a lot more valuable then. That was the kind of the bubble years. But when you go back earlier, um, the 2019, like actually the multiples were lower, even for, because that was kind of the median was 35%.
Uh-huh.
So they were trading at like 7 times back in 2015, like 10 years ago,
Uh-huh.
just to kind of, so there's extraordinary premium now. More, it's that line is steeper than ever. Really, that what you get rewarded for growth.
For growth, right? As
Yes,
opposed to
yeah,
profitability,
which is,
right? Yeah.
it's interesting. I don't think we think about it in that way
Mhm,
necessarily because we're all thinking like, oh, it's much harder now to get a good valuation.
mhm,
Actually, if you're growing fast, you're going to get a much better valuation. It's much steeper. Yes, you're not going to get the 25 times that you got in 2021. That was brief though.
mhm.
And of course, if you're an AI native company, you're going to get an NM valuation.
Right, right,
It's
right,
not meaningful. You can't really compute it,
right.
and we'll see. Some of those will make sense, but you know, many of them probably won't. Ultimately, we'll see.
But in general, you're saying, if you are public or private, you're saying, focus less on profitability and focus on the growth number.
If
If
you
that's
can,
yeah,
so there'll be a temptation to say, well, okay, let's go back to the growth at any cost, and
yeah,
that will not work. So, here's what I will say. You shouldn't trade off growth. You shouldn't trade off growth for profitability if you can attain the growth.
right.
But if the growth that you're getting is based on bringing in customers that are going to churn quickly and so on, like that's not going to be worth it. And so that the third metric, like the third slide I would show, probably the third slide I showed with Jocko when you were there back in May, and I sort of repeat myself on these things, but you can't say these things too much, really, they're still true. Like um, it's interesting with data. Sometimes people are like, they have this hypothesis, and they'll want to pull the data out of my platform, and it's not there. Like they'll see
Mhm,
something and they're like, well, this doesn't say anything. Like I know I'm going on a tangent here, but it's this important point. Like when you get those canned reports of like benchmarking reports, and they're beautiful, right? And they've been put together by a whole team of folks, and they'll each page will have like a message because
mhm,
that's what you're trained to do. You're supposed to make every page make sense. Um, and the problem with my platform, it's not really a problem, it's just the truth, is that sometimes you have a hypothesis and you look at it and you say, I don't see anything here. There's noise here.
mhm,
That's data. Like that is what data is. Um, and so that's an answer too, by the way. Like, well, maybe there isn't a pattern here, or maybe we need to wait for more data to come in. Um, but then you find things where there is something, and a lot of times it's things you expect. We all expected to see growth go down. We all expected profitability go up, and lo and behold, we see it.
mhm,
Um, and you can look at that and say, okay, like this is giving me a message, and it's freaking loud and clear.
mhm,
And so the things we just talked about, those are loud and clear. There's another thing that's loud and clear. This is that third slide across these 85 companies over the last, this is like 5 years of data every quarter, and you see the
mhm,
trends, and it's super clear. And that is that go to market, as much as we can see it, because basically we're just getting accounting data from the 10Ks and Qs, and we pull it in automatically into our platform. It's kind of cool how we do it. Um, and what you see, and go to market is sales and marketing, and of course we don't have it disaggregated, but you can go look and say, well, how effective is that sales and marketing spend when we look at the countervailing numbers of growth or ARR, net new ARR, and we see something really clear. So you do see sales and marketing spend as a percentage of total revenues going down.
mhm,
And of course, if you're doing this math and you're just counting along, that free cash flow as a percentage of revenues is going up. So you must be doing things more efficiently as you're measuring it that way in terms of your expenses. Your sales and marketing expenses actually are a big piece of that, and you see it.
yep,
In fact, you see half of those gains, roughly, half of the improvement coming from sales and marketing as a percentage of revenue. It's down from
mm,
I don't know, I don't remember the numbers offhand, but it's down from like the low 40s to the mid 30s, as I recall.
wow,
So again, people should take a victory lap there, but not as much of a victory lap because here's the thing. What you really want to measure if you're a SaaS business, the whole idea of SaaS And whether it's a subscription business where it's literally like contracted to recur, or whether it's like a snowflake like business where it's based on usage, um, the whole idea is that people are going to keep coming back. And so, yes, you spend a lot on sales and marketing to bring them in, but then the renewals should, it's not that you should do nothing. You gotta do your customer success, and you gotta deliver a good product and service, but it should be a lot cheaper. That's the whole idea behind the economics of SaaS.
Right.
And so what you should measure is not sales and marketing spends as a percentage of revenues. You should be measuring it based on what you're trying to achieve, which is net new ARR, growth in ARR. And that growth comes from selling new logos. It comes from upselling, which should be cheaper. And it comes from like making sure you're not losing folks through churn. So rather than measuring the sales and marketing spends as a percentage of total revenues, you really should be measuring it as a percentage of the net new ARR. And the kind of the way I like to think about it is it's a cost ratio.
Hmm.
Um, and it's like, well, how much did we spend in the last year? How much did we spend in sales and marketing? And then comparing that with, well, how much did our ARR move? How much did it go up? Hopefully it went up. Um, and so it's like, and then you can do that simple division and say, well, we spent $2 for every um, $1 of net new ARR, for example. And that's like actually where things sit right now. It's about
About 2 to 1.
208, I think, is the number. Um, that number is up about 70%, meaning worse. So higher is
Right, right,
worse. Right?
right.
Uh, it was like a dollar 23, 24 back in 2021. Now that one was a little bit like 2021 actually it was, kind of a low point, so
Yeah.
I'm not saying you gotta get it back to a dollar 28, and in fact, different companies like, the risk is you can't just say, "Well, that's the number," like,
Hmm.
I if you're earlier on and you're bringing a lot of new logos, it's gonna cost you more, like, that's just the way it works. You really have to break it down, so this is less of like, well, you everybody should be sitting at a dollar 30 or something like that. It's more like, well, where were you before? Sometimes benchmarking is not just looking at at your peers. Yes, you should always do that, but you should also look like, where were you a year ago? Where were you 2 years ago?
So help me understand. Like you've basically described that, the sales and marketing spend is decreased. It was in the 40s, now it's in the 30s. Yet the cost to acquire a new AR has gone up from, call it a, buck 24 to $2 plus.
Yeah.
How do you reconcile those two things?
Yeah, no, it feels like dissonance there, like that doesn't make sense, but the actual costs have gone up, the total cost, like most people are spending more. So
Yeah.
um, be aware of that. But what you said isn't wrong. And I mean, in some ways, you can look at the math and say, okay, I kind of get it because we're not growing as fast. So if you're not growing as fast, you shouldn't be spending as much. Like
As much.
they're not as successful. Like
Mhm.
whether they're losing a lot now. How do you fix it is another thing. But you have to get past the like, well, those things don't seem like they go along with each other. Like you're spending less as a percentage of revenues, but you're spending more as a percentage of net new ARR. And the fallacy is that as you get bigger, you just get to spend more. Um, I mean, you do in a way because it does reach your profitability, and this is the beauty of a SaaS business as well, right? This is the beauty of it. But so here's where I'll veer into kind of what we're seeing in the private companies on our platform.
Okay.
So if you look at if you look at private, like PE backed companies with, let's pick a threshold, and the one I like to pick is 50 million, which is
Yep.
a pretty low threshold, right? Because if you're below 50, like, yeah, all bets are off in terms of how profitable you can get. Like, you really need to be scaled. But if you look at the companies on our platform, and we have, that are PE backed, that are 50 million in ARR, we're over, we're kind of like 60 companies. So that's enough where you
Mhm.
and the data's super high quality. I mean, they go in with a fine tooth comb to get this stuff. Those companies are, um, their free cash flow margins are
Oh,
in the
wow.
30s, like they're
Okay.
twice as high. Um, and that tells you something. Like now, some people I've posted on this. Some people say, "Well, that's just because they picked the more profitable businesses," and that's true. I mean, I'm sure that's I don't have the history, so I can't, I don't know the names of the companies, but they've also improved the profitability of these companies. Yes, they picked good companies. They should, but I think we all want to be good companies, and the way you do it is you fix this. You have this. So if you're the bottom line here is if you're going to grow 15%, which is the median, um, being only at 18% free cash flow margins probably isn't good enough. Like
Mhm.
that's probably not where you need to be if you want to be successful and get a good exit or get a good valuation. You're still not going to get like the really high valuations that companies who grow at 30% get, because that's just, again, if you can do that, go do that. Like go
Right.
do that and spend the sales and marketing efficiently. But if you can't get there again, and you want to be successful and pay your people well and get a good exit, get a good valuation, even in the public markets. Although I would guess, some of these companies, if they can, and we're seeing it already, continuously, like they get gobbled up by PEs, and guess what the PEs see? They see this inefficiency that they can fix.
Exactly.
Yeah,
Yep. So one of the things that you mentioned earlier is this kind of, lumping sales and marketing together into a spend. And one of the things that struck me when I heard you talk last time is this really thinking about revenue in different buckets, thinking about like what is the new logo sales, what are the upsells and expansions, what are
yeah.
the churn. Can you talk more just about like how you tell companies they should be breaking that stuff out and thinking about those?
Yeah, I love this topic, and the thing is, I always, and when we did that survey each year, there was a point where I was like, I want people to break out that spend. So everyone has a pretty good idea. Everyone is doing SaaS metrics to do the NRR and the GRR calculations. You really do need to break out the top line where you're getting your ARR. So that's being done. Although a lot of accounting platforms are not doing that yet,
Hmm,
but like NetSuite is absolutely doing it now.
interesting.
We partner with them on various things, and we're really excited that they're doing that now. So it sits in your accounting system.
Right.
So that's huge. What doesn't sit in the accounting systems, really, that I'm aware of anywhere, is a similar breakout. And what do I mean by that? Well, what you need to do in accounting, but also just a thinking person, like, well, the sales and marketing, how much of that spend is being dedicated towards new logos versus upsells and expansions? I'll put those together. I mean, people have different views about what those are, but let's put
Mhm.
that together. Um, and the churn, or stemming that churn, that's usually customer success. Like people can say, okay, I can look at that,
Mhm.
but most people are not breaking out, and even like some amazing companies and people who are really thoughtful on this will still push back when I ask for that information. And when I started to put this all together, I actually had in the platform asking people to break that out. And I got too much pushback, and I don't want, and one of the things, I want this to be super easy. Like if you're tracking the metrics, and turns out most people are not tracking that. Some
Interesting.
people are, but most people aren't. And if you're going to fix this, because that's always the question, like, okay, ours sucks. So how do we fix it, David? And I'm like, I can diagnose a little bit, but I'm not an expert on fixing. But what I can say is like we need to go to the next layer. We need more tests.
Oh, yeah.
We need more tests to figure out what's wrong. And the first level of tests is to break out those costs, and that's key. And even if you don't do it in your accounting systems, although it'd be nice if you did, but even if you don't, take a stab at it. Like,
Mhm.
all right, you spent X on Dreamforce. Um, how much of that you think it was related to basically serving your base versus finding some new customers, and
Most-
and that is really even if you're it's a guess, like, "Oh, I wonder," um, that's still, like, the best first step, like, take a guess, and then the next year, you'll probably be a little more cognizant of trying to figure it out.
Shifting gears here a little bit, we're talking all about traditional SaaS metric terms here, ARR, NRR, ERR, et cetera. Um, Obviously, the hot topic these days is pricing models, right?
Yep.
How do you think that as somebody is shifting into, and obviously, like, AI companies are not the first to ever have done this, right? Obviously, AWS,
Yeah.
Snowflake, there's lots of models and consumption-based models. But how do you tie those things together when you're talking these traditional, like what people think of as seat-based metrics with these new pricing models?
Yeah. Love this topic. In fact, I just posted, something yesterday that was sort of in response to this, because I've had a few posts, where I'm basically arguing ARR is not dead. Like,
Mhm.
it's not dead. Um, and here, let's just go back to kind of basics. So when I think about what matters for any business that has recurring revenue, and even whether it's subscription pricing where you get the money in advance, or it's usage based. Again, Snowflake's kind of the typical one people will cite that very much moves up and down. But either way, regardless of how you contract and how you price, there's still these prime questions. They're just primal. The how big are you? Like, how big is your base of recurring revenue? Forget about the customer service and one time stuff.
Mhm.
Just even if you're 100% like outcome based, you still have this notion of people who are paying you each year.
Paying you on a regular
So
cycle.
how big are you?
Yep.
Um, we call that ARR. Even in the new world, like, that's still going to be ARR. You can come up with a different term if you want. I'm going to stick with ARR for now, and if something else comes along, maybe we'll change that name. But it's how big are you?
Mhm.
And then the next question: well, how fast did you grow?
Yep.
That's growth rate. That's ARR growth rate.
Yep.
How much of your existing base? How much did it expand, or God forbid, contract? That's NRR. And then if you just want to be a purist about it, tell me just that base, like forgetting about people who expanded, how much did that contract? That's GRR. Those are like some of the most important metrics, and those live. Like,
Uh-huh.
regardless of what your religion is on this, and I firmly believe that the subscription stuff um, is going down. There's a guy you may have worked with him, Brett Queener, who wrote a really
Yep.
good piece that coincided with one of my pieces saying, "Hey, AR is not dead," and his piece was, "It's the end of the AR world as we know it." And I'm like, "Uh-oh." But it turns out he was focused on the contracting side and the pricing side, and I 100% agree there. But if you're a metrics guy like me, you're like, you can come up with some new names if you want, but those 4 questions I just told you, those still matter. Now,
The
there
com-
may be some other metrics, and I'm convinced there will be, that come around that are related to how these AI and agentic solutions are working, that we're going to want to track too.
Yep.
But I still think that these base metrics are going to be critical, whatever you want to call them.
Yeah, fundamentally, you're still going to have a financial relationship with a company, right? And that may be less predictable in some ways,
Yeah.
but it is one of those things that also all the crazy hypergrowth we've seen from the dev tools players have come from that model, right?
Yeah.
Right.
Yeah. No, absolutely. So, it will be less predictable. I mean, if you look at the NRR, and I think they actually call it NDR at Snowflake, it's down the most. Now, it's still like higher than virtually everybody else, but
Mhm.
it's down from, like, I don't know, 170 to 130 or something. And so it's going to move. Just when you do the metrics, uh, don't get cute and include the notion of contraction in one set of calculations and don't include them in another, so that you just kind of like, that's not okay. And that's why our platform was built in this way, where you kind of have to live and die by the sword either way, so that and you see how the calculations are done. They're fairly simple, but they're reality. Yeah.
Yep. So what kind of putting a bow around all of this, what would be some of your key recommendations for, revenue leaders and CEOs in terms of things that they should focus on in their business to really kind of stay on top of this and be best of breed?
Yeah, well, I mean, the first thing is this is very, biased, as a former banker and kind of metrics driven person, but you should know these metrics cold for your business. Um, and a lot of people don't.
Mm.
And, the CFOs do, the good ones certainly do, but and the CEOs often do these days, but even then they can be, you know, and it's okay to talk about them in a certain way when you're marketing, but when you're like with your managers, um, everybody should be on the same page. They should be looking at the same things and focused on the same goals. The companies I worked with, this even goes back 5, 10 years ago. Uh, I remember Bill.com was a client of mine, and John Reddick, the CFO, came to me and he said, I want to have a 2 hour meeting with all of our senior people. So there was about 12 people in the room for 2 hours, and we went through every one of their metrics. And
Wow.
then they were keeping track of those metrics from then on. This was like a year before the IPO.
Huh.
And they were not the only ones like that. And that's what needs to happen. I also think that there's I've learned a lot about go to market because I was not a software go to market person. I interview the head of sales, the CRO as part of our due diligence processes on deals. But now this is I've found the go to market people are definitely my route into kind of helping these companies. And I am a big believer, and I was astounded that this didn't happen as much. I'm a big believer that the RevOps people and the CRO uh, folks working with the CRO should be attached at the hip, especially the RevOps person with
Yeah.
the FP&A person who works for the CFO. Like those things, just they should be melded into one.
Yeah.
And I don't think that's happening at a lot of companies.
And it also sounds like if you have the opportunity to goose growth without, kind of affecting profitability, there's obviously an efficient frontier in there somewhere. That's what you're getting rewarded for today.
I think so. Yeah, a lot of people will look at what I'm saying as like I'm focused on efficiency, and I am for sure. But at the end of the day, I'm still like go for the growth. Just go for it if you can. So that is absolutely where you're going to get rewarded.
And then it sounds like also just getting that awareness of don't treat all revenue the same. Really think about like
Absolutely. Yeah.
what are the kind of, how do you not only break out the top side, but also kind of what are the cost drivers,
Yes.
for each of those things,
Yeah.
right?
Where's your lowest hanging fruit on your opportunities for sure?
Fantastic. Well, I know we're almost up at time, David. So let's shift and find out a little bit about you
Oh, the
as a
fun
person.
questions. Yeah. Okay.
So here's a speed round.
I'm ready.
Like, what's something we'd be surprised to know about you?
This is kind of like the fun facts. So, this is something that maybe this is the wrong kind of answer you're looking for, but my mother was born to a gentleman, my grandfather, maternal grandfather, who was actually quite old when when he had her. So
Okay.
I had a maternal grandfather who I knew quite well, who lived to 100,
Wow.
and he was born in 1886, and I feel like I know him, so, like, I knew him quite well,
That's
and so he lived to 1986, and, he was born in Germany long before World War One, and this is someone who, he worked until he was 100 actually, and worked in the World Trade Center of all. I used to have, lunch with him at Windows on the World, every year or 2, and, I feel connected to, the world of pre-automobile.
wow.
So that's something I just, am amazed about when I think about, like, something that's interesting.
That's crazy. I mean, I remember as a kid wondering whether the world was black and white, in early days because I didn't realize there
No,
was.
that's fair.
Yeah,
Yeah.
yeah.
You watch The
Um,
Munsters and The Addams Family like me. Yeah.
exactly. What do you like to do for fun?
Well, I've posted on this. I am in an '80s rock cover band,
Wow.
and, we're talking here pre, Halloween when we just discovered, Doug, you and I both live in Marin, so I'm expecting you to attend our,
Okay.
Halloween concert up in Novato, and there's everyone needs to come in costume, and there's a costume contest, and we're actually pretty good. So I play keyboards, and
Okay.
that is like definitely one of the really fun things I do.
All right, so this may publish afterwards, but I'll put a post out on LinkedIn.
Yeah, and
But
we play every month or
but
two.
the name of the band?
It's called Cover Story.
Cover Story.
Yeah,
Great
yeah,
name. And
yeah.
where are you playing for Halloween?
What's that place? I forget the name of it. This is horrible, but
Is it
it
Hot
is
Monk
they have
or is
a
it
it's not Hot Monk,
yeah.
it's across the way, it's in downtown. I'm just forgetting the name of it, but I'll
All
get
right,
it to
well,
you.
we'll find it,
Okay.
I'll put a post
Yeah,
out before it. Yeah, that
yeah,
sounds good.
yeah.
Um, and then, what's a product that you love or just has made a difference in your life?
Yeah, this one was interesting. I mean, of course, like all the AI products, but here's the thing. This is the thing that has been so eye-opening and amazing for me is when I started to build this company, I, realized it's solopreneur and I haven't taken funding, and so for a lot of reasons, I realized, I kinda need to do the guts of it. So I rolled up my sleeves release of Chat GPT and started learning SQL, and now
Mm,
I'm using PostgreSQL, and now I have all the benefits of Claude and
okay,
OpenAI and to help, but I really fundamentally work directly. I don't use Cursor. I work directly
yeah,
in Postgres, and I fricking love it. Like it is so powerful. And so that and it's like a spreadsheet on steroids that
mhm.
is ultimately programmable and produces, things that I just couldn't have imagined doing even a year or two ago. So that is my favorite product, an open source product, but man, it's a killer product.
Spoken like a true data guy,
Yep.
and very old school. I love it. I love it. And then just finally, how can our listeners stay in touch with you and kind of help you on your journey?
Yeah, reach out. I mean, obviously, I'm very focused on getting in, which is, the number of quality companies high. So I'm really wanting great companies to, come to the platform. You can do it directly.
Mhm.
It's saasmetrics.benchsites.com. And if I don't know you, you'll be asked to just tell us a few things about yourself so you can get the entry pass to come in, and then you'll be anonymized. But you can reach out to me on LinkedIn. That's probably the easiest way to get me directly if you don't have my email address.
Fantastic. Well, David, great chatting with you today. Thank you so much for coming on the show.
No, thanks for doing this, Doug. I really appreciate it.
All right. Take care.